Most Australians know they should be investing. But when you actually try to start, it feels impossible. Stocks, bonds, managed funds, brokerage accounts. Where do you even begin? Here's the thing. There's one investment that Australia's wealthiest families have quietly used for decades. And right now, you can start with as little as $100. It's called an ETF. And by the end of this video, you'll know exactly what it is, how it works, and how to buy your first one today. Welcome back. On this channel, we take Australian money topics and explain them simply using visuals. No jargon, no suits, just clear explanations you can actually use. Let's get into it. To make this real, let's follow Jake. Jake is 27, lives in Brisbane, earns $75,000 a year, and has $8,000 sitting in a savings account earning 1.2% interest. He knows inflation is eating that money. He wants to invest, but has no idea where to start. Sound familiar? ETF stands for Exchange Traded Fund. Let's break that down. Imagine you walk into a supermarket. Instead of buying one single apple, you grab a fruit basket. It has apples, oranges, mangoes, grapes. Different fruits. One basket, one price. An ETF is exactly that, but for shares. Instead of buying one company, say Commonwealth Bank, you buy a basket that holds hundreds of Australian companies all at once. BHP, Westpac, Macquarie, Woolworths, Rio Tinto, all in one. When any of those companies grows in value, your basket grows too. When one company drops, it barely moves the basket because you own 200 others. This is called diversification, and it's the #1 reason financial advisors recommend ETFs for beginners. Now here's something most people miss. Fees. There are two types of investments most Australians compare. Managed funds, where a professional picks stocks for you, and ETFs, where you just follow the market automatically. A typical managed fund charges around 1.5% per year in fees. A typical ETF, around 0.07% to 0.2% per year. That sounds like a small difference. It's not. If Jake invests $100,000 over 20 years with a 10% annual return, a managed fund at 1.5% fees leaves him with around $520,000. The same investment in an ETF at 0.1% fees? Around $660,000. That's $140,000 difference, just from fees. That's the fee trap, and ETFs completely avoid it. All right, let's get back to Jake. He decides to invest $500 a month into a broad Australian ETF, let's say VAS, which tracks the ASX 300. The long-term average annual return for the Australian share market is around 10%. After 5 years, Jake has put in $30,000 of his own money, and his portfolio is worth around $38,000. After 10 years, he's put in $60,000, but his portfolio is worth $95,000. Growth is starting to compound. After 20 years, he's contributed $120,000 of his own money. His portfolio? $343,000. Over $220,000 of that came from the market, not from Jake's own pocket. That is compound growth, and the only way to access it is to start. The longer Jake waits, the more of that $220,000 he gives away. So how does Jake actually do this? Here are the 4 steps. Step 1. Open a brokerage account. In Australia, popular options include Stake, CMC Markets, and CommSec Pocket. All 3 are free to open. Stake and CMC have lower brokerage fees, usually $3 per trade, compared to CommSec's $19.95. For a beginner, Stake, or CMC, is the smarter choice. Step 2. Deposit money. Transfer from your bank account can take 1 to 2 business days. You can start with as little as $100. Step 3. Search for a ticker. For Australian shares, look up VAS. That's the Vanguard Australian Shares ETF. For global diversification, look up VGS. That's Global Developed Markets. Both are low-cost, trusted, and widely used. Step 4. Set up a recurring investment. Most brokers let you automate this. $200, $500, whatever fits your budget, so investing happens without you thinking about it. Quick but important. ETFs are not risk-free. The share market drops, sometimes badly. In 2020, the ASX fell 35% in 6 weeks. In the GFC, it fell nearly 50%. Jake's portfolio will have scary months, maybe scary years. The key is time. Every single time the Australian market has dropped, it has recovered and gone higher. The people who got hurt were the ones who panic sold at the bottom. If Jake stays invested and keeps buying, those dips actually work in his favor. He's buying more units at a cheaper price. This is called buying the dip, and it's a feature of ETF investing, not a bug. Let's bring it all together. ETFs are baskets of hundreds of shares. One purchase, instant diversification. They have tiny fees, typically under 0.2%, which saves you tens of thousands over a lifetime. They let compound growth do the heavy lifting. And buying them in Australia is genuinely 4 simple steps. Jake started. You can too. If this video helped, hit subscribe. Every week we break down one Australian money topic with clear visuals and real numbers. Next week, the top 5 ASX ETFs for Australians in 2025, ranked by fees, performance, and what each one actually holds. You don't want to miss that one.